Welcome to the June 2023 monthly motor checkup. My name is Dave Lundgren, and I'm the Chief Market Strategist and Portfolio Manager here at MOTR Capital Management and Research. The title of the video this month is "The Elephant in the Room is Not a Bear, It's Just an Elephant." Before we get started, take a look at the disclosures here. Okay, the elephant in the room is not a bear, it's just an elephant. So the elephant in the room is obviously sentiment measured many different ways, and all these things that investors are concerned about and worried about, whether it be surveys are too bullish given the backdrop of potential economic slowdown and uncertainty around the Fed and war and et cetera, or the volatility index is too low, which sounds like perhaps there's too much complacency, or market breadth is too weak and that's unsustainable and that therefore it's bearish. Or more recently, we're hearing more and more that AI is a bubble. So all of these are the bricks in the wall of worry, and it's a very large wall. However, if you actually look at the data, what we find is that although investors are insisting that this elephant is a bear, the data just doesn't corroborate that view. And of course, we'll walk through that in the video. I would just highlight one thing, though, that if the bears couldn't take down the market with a banking crisis in their arsenal, then I think it's probably safe to assume that the lows are in. We don't need the banks to necessarily lead, but we do need them to stabilize, as I've been saying basically since the crisis began. And it looks to us like that is indeed taking place, which is a constructive element at the margin for the market. The leadership remains very cyclical, and it's just getting stronger and it's getting healthier. Your long only investors should be exposed to this bullish exposure, pro-cyclical, industrials, technology, materials, and consumer discretionary. And long only investors should be well aligned with that bullish messaging, which has been sort of playing out over the past several months, 6 months at least. While there's still a decent number of short setups, which has to do with that breadth divergence that most people are familiar with, nonetheless, the exposure to shorts should be light overall, and you should have a quick trigger finger to cover those shorts if you haven't already. Should the risk gauge on the quarterly time frame tick higher, and I would just say that just looking beneath the surface, the quarterly risk gauge is very close to ticking higher. So let's jump into this wall of worry. So to begin with, according to the American Association of Individual Investors, the percent of bullish survey respondents exceeded bearish respondents by 20% for the first time since the bear market started. And you can see that over here, this red arrow with the gray bar there. So for the first time since the bear market started, we're now at 20%. And while this has caused many bears to rise up on their haunches and get courageous in their calls, they're likely to get trampled by the bulls. If you just look at the data, this is what we see. So the full period returns all the way back to the beginning of the survey. There were 1,861 surveys, so that's quite a number of surveys since the beginning. And the average returns over that period, 3, 6, and 1 year returns, are featured here just for comparison purposes. Now, if you look at all of the instances where we've had a surge to 20%, while the average survey is still negative, which is the setup we currently have, there have been 28 of those since the beginning of the survey. And looking at the forward returns, when you have these instances, they're well above average returns. Now, what's interesting is when you break this down further into two different subsets, and you break the amount of time that we've spent in bearish territory, where the bears have exceeded the bulls for a prolonged period of time, and you break it down into bearish periods for less than average time versus longer than average time, you get some pretty remarkable results. So when you get a 20% spread in 1 week after a period of bearishness where that period was less than average, you get returns that are actually pretty mediocre and certainly well below average. It's not until you get these surges of a spread of 20% or more, when the time below zero has been above average, that you get these well above average returns. And of course, this is important because this is the setup we have. So this bullishness that everybody's pointing to and saying this is the most bullish investors have been since this bear market started, so therefore it must be the best opportunity to short, it's actually quite the opposite. When you get surges like this in sentiment after such a prolonged period of bearishness, that's actually historically been a bear market killer. And I'm leaning in that direction. That's indeed what we're seeing. A lot of folks are also pointing to this volatility index and how it's made its way down below 20, thereby indicating a significant amount of complacency. I would just remind you that the VIX is descriptive. It's not predictive. And what I mean by that is that the highest volatility happens in bear markets, not bull markets. So when you see high volatility, that's not forecasting a bear market, that's identifying a bear market. And when you see low volatility, that's not forecasting a bear market from there because everybody's complacent. It's identifying a bull market. So low volatility indicates a calmer macro environment. And of course, that calmer macro environment contributes to investor confidence. Now, that sounds in and of itself like it's bearish, but it's not bearish until that confidence gets to an extreme. And clearly, we're nowhere near that. So just take a look at these periods where you've had persistently subdued volatility, and you can see that these tend to dovetail with bull market environments. And so now that we've got the backdrop is starting to shape up from a trend perspective, we've just got this surge in bullishness from the AAII survey. VIX is now below 20. These are steps that we can identify along the way of moving from a bear market to a bull market. So with the VIX below 20, I'm more inclined to be reading that as that's the market's interpretation of a transition into a bull market. So this is describing that transition. It's not predicting complacency and therefore a resumption of the bear market. This is a chart that I featured in the past as well. This is the University of Michigan consumer sentiment, which you can see down here. It goes back to the 1970s. And this level here that we just struck, or was that recently, was a record degree of negative sentiment, even worse than the early 1980s. And so when you find these dire periods of dire sentiment, they tend to be what plants the seeds for a strong bull market going forward. And you can see that here. So we are currently also, importantly, far away from any level of bullish sentiment from consumers that would be your typical bull market killer. So we want to be mindful of the idea that as sentiment starts to increase, we're far away from extreme optimistic sentiment. And of course, the bears are also spinning the massive breadth divergence as being unhealthy and unsustainable. This is something that we've covered quite a bit in our notes as well. In fact, we created this index, the MOTR index the MOTR management index to depict these 9 stocks that are leading the way. Management is an acronym for these 9 stocks, and you can see they have been very strong at the same time that the average stock has been very weak. And of course, this has a lot of folks interpreting this as being bearish. So I want to point out about this particular divergence is that unlike most breadth divergences, this one is actually taking place at the start of a bull market, not at the end of one. So we're familiar with divergences that happen at the end of a bull market, and they do a great job of warning of a transition from bull market to bear market as the breadth and support of the market begins to thin out. But this is a divergence that's happening at the beginning of a bull market, and this could just be that. By the way, this is how all bull markets begin, that the new leadership actually takes off before the market. So it's possible that that's exactly what this is. So the point is that although it may not be bearish ultimately, it could actually resolve bullishly. And then finally, even if it does resolve bearishly, the point is it doesn't necessarily mean that it's bearish right now. And I'll show you an example of that here. So the last time we had such a glaring divergence after a bear market bottom was in 1998. So the 1998 bear market was indeed preceded by a bearish divergence where you had the NASDAQ move to new highs and the average stock did not. This is the value line geometric average. Did not confirm that high. That ushered in the bear market. And of course, this is the type of divergence that has people worried about what we're seeing today, but you can clearly see that this is a divergence at the end of a bull market, not at the beginning of a new bull market. But nonetheless, most stocks bottomed off the 98 bottom, which you can see here and here, NASDAQ moving higher, as well as the value line geometric. But by the mid 99 period, the average stock rolled over. And then that's actually when the bubble began. So I would say that it's possible that this is where we are, where we bottomed in October, everything went off the bottom, rallied together, and now we're starting to get this divergence. It's possible that this is just the beginning because, again, this divergence happened after a bear market bottom. And so we have the ingredients for a bubble with our artificial intelligence, which we'll talk about in a moment. But the takeaway here is just because we have this divergence, it doesn't necessarily mean that it's bearish. Even if it is bearish, it certainly doesn't necessarily mean that it's bearish right now. So I think you just want to really keep an open mind. Obviously, ultimately, the divergence did matter, but it wasn't until after the bubble happened. And of course, bubbles can be quite rewarding if you're involved in them. Of course, this is the artificial intelligence instead of the new economy. We all know it today as being artificial intelligence. And so finally, to that point, the bears insist that this is an artificial intelligence bubble. Now, most people who know anything about bubbles or maybe have invested in them in the past or have studied them know that they typically are they are periods of rapid asset growth. And you would think that if this is indeed a bubble, that the asset class we're referring to would at least be at an all-time high. And you can see here we're nowhere near that. So from that perspective, this does not look like a bubble at all. The other thing too is the historical return. When you look back over the recent returns for a bubble, they tend to be quite strong. And if you look at this index, this is the robotics and AI ETF. It's bots, and I didn't cherry pick this. I could have chosen any AI ETF because they all look like this. But this ETF is basically unchanged over the past 5 years. Again, that doesn't sound like a bubble. Maybe it's going to be a bubble, but if it is, clearly we can see that there's much room to go before we have something to worry about. So we also see here that there's a massive relative performance downtrend in place, and so none of this harkens to a bubble. So if indeed it is a bubble, I think we still have that to play out yet. Something's clearly to watch for, but at least by traditional measures, this does not by any means look like it's a bubble right now. Now, of course, the challenge with sentiment, and that's driven by all of these inputs, whether it's breadth, surveys, bubbles, and things like that. The issue is, and of course, banking crises and whatnot, is that the sentiment tends to be really bearish when everybody understands what's going on. And I've featured this chart in the past, but the issue is that the market has already, because it looks forward, has already discounted all that information. So by the time we understand it, the market's already moved past that and is beginning to look forward to better returns down the road. And the biggest challenge is that as the bull market actually gets underway, then it's not uncommon for the news to actually get worse. But the market, because it already knew all these things and it already anticipated and kind of discounted and digested it all, continues to move higher as the news gets worse. And that's what makes it very difficult for investors. So as I've noted in the past, some of history's largest bankruptcies have actually happened right after new bull markets began. And you can see many of them here after the 2009 bottom. You can see them here in the 80s, of course, after the bottom in 2002, and we have it playing out right now. The FTX bankruptcy happened right at the bottom, and since then we've had 3 very large banks go under, and the market has absorbed them quite well, which again is something I alluded to earlier, where we had 3 of the 4 largest bank failures in U.S. history. And despite that happening, we still did not take out 3,800 supports. That's very classic in terms of how the markets climb this wall of worry and how markets transition from bear market to bull market. And I think we can chalk this all up to being that exact type of scenario right now. So just looking at the risk gauges currently, the daily time frame for the market level risk gauge, which you see here, is at 4. So it's very, very close. And just looking at the data this morning, it's very close to ticking up into risk on. So I anticipate that is indeed what's going to happen. The important thing to note is that during the banking crisis, neither the weekly nor the monthly ticked below 5. So we had held in very strongly here. And again, that was an indication that the market was weathering that really bearish news rather well. What we haven't yet gotten is the uptick into 6 and for it to stick there. We've had it kind of waffling back and forth between 6 and 7, showing you how close it is to upticking. Right now it's back down at 7 again, but it's extremely close to ticking back to 6. It won't be a finalized number until the end of the quarter, which happens to be the end of this month. But if indeed this does tick up, that's just a green light to cover all shorts and just stay focused on that long book, which we've been talking about in all of our notes in these videos. So to that point, and perhaps most importantly, leadership for the first time is now recording risk-on measurements across multiple timeframes. So again, this is not something that you want to wait for before getting long these sectors. As you know, if you've been following our work, this is where we're long. We're long tech, industrials and consumer discretionary, materials and healthcare. That's what our exposure is. We're almost fully invested here. We're waiting for the quarterly to tick up to 6, which will get us to cover all our shorts and gross up the rest of the book. But as a long only investor, this is exactly where you should be invested. It's where you should, this is where the evidence has been kind of morphing towards in terms of leadership. And again, market being a forward-looking discounting mechanism, if this is what the leadership is, it just does not strike me as a situation where the market is concerned about what it sees in the future. It looks pretty robust and rather bullish. This is another notion that, I have to say, even myself, I believe is to be true as well, but it's true in the majority of cases. And this is something we need to keep an open mind to as we go forward. But bull markets are never led by the same leadership that led the last bull market. Again, something I believe in myself, but we want to keep an open mind because it's not necessarily always true. If one stuck to this view that past performance does not lead the next bull market, you would have never have bought Amazon and many other stocks actually off of that bottom that did quite well. So, we don't want to be dogmatic about it. It's very likely that most stocks that did lead the last bull market in that stay-at-home craze and all the blockchain craze and everything else that drove, GameStop and AMC and all these other crazy stocks to the moon, that's very likely that they're not going to be leadership. But that does not mean that a lot of these stocks that are tied to blockchain, legitimately tied to AI, won't be leadership going forward. So keep an open mind to that. And what's perhaps most important is that when you look at the long-term trend here, the NASDAQ actually never broke its trend. So you could make the case that this leadership never actually gave up leadership, both price and relative. So again, keep an open mind. We'll talk more about the alternatives for leadership beyond technology because it's not the only thing working. But I think technology does need to be a significant part of your exposure on the long side for long only and for long short investors. So just quickly taking a look at the benchmark itself, with this 42 to 4,300 barrier that we've been highlighting for what seems like forever has finally been overcome. So this was a key step. Again, progressing from bear market to bull market is a series of steps. This was a major one in the checklist of trend change. This is a critical one. You can't have an uptrend unless you have a series of higher highs. We now have a higher high. So this is a critical step. And so now we can look forward to where we might stumble into next resistance. So I would think this 45 to 4650 area is likely to be where we're headed, but it's also likely where we're likely to see some resistance. And so that's okay. The point is expect resistance there. If it happens, don't get all concerned about it because this is exactly what should happen. This is a very natural place for the market to stall here. As we're working our way up to that resistance area, any weakness that we do see, we should see that former resistance now become support. So 42 to 4,300 is now very likely support for whatever effort we make to continue higher from here, which I suspect will happen as the year progresses. When we're looking at leadership as it stands today, I think this will be a key ingredient here. We already know that tech, industrials, and discretionary are all part of the leadership. All are very strong. There's plenty of stocks to own throughout each of those sectors, including materials as well. Keep an eye out in the weekly MOTR reports. We provide a list of buy ideas from all the leadership sectors. Every single week, it's 20 to 30 buy ideas. They're bases that are either have yet to break out or just recently broke out. So there's a lot of things to take a look at for idea generation. But the point is that the durable aspect of leadership going forward may well hinge on what interest rates do. So, the value versus growth relationship has tended to follow the 10-year, the trend in the 10-year rather closely. And you can see that here from 2003 all the way down. You can see it's a very strong relationship, not perfect, but clearly very strong. And with the bottom in interest rates here, that's what unlocked in turn the trend in favor of value away from growth. So when you drill down on this trend from the COVID lows, which is 2020, and you take a look at the trend since then, the the last, I guess, pause that we had off of COVID lows was in 2021, and it basically, the setup we were given there was the 50-day average rolling over, which is this red line, crossing below a rising 200-day average, and then beginning to rise again. We have that same setup today. So we have the 50-day falling and below the rising 200-day average, and it's beginning to turn higher. So I think it's a good indication that we should anticipate higher rates from here. While we're waiting for this to unfold, my suspicion is that 3.5 will be major support. That's roughly where the 50-day average is right now. And then as we're continuing to monitor this, any movement above 4% is likely to cause some transition away from especially high valuation growth stocks. And so the question therefore is, of course, where is that leadership likely to transition if it's coming out of high valuation growth stocks? So this is a chart that I've featured many times, and I think it's in this conversation definitely worth highlighting once again. So this is the American Industrial Renaissance ETF, AIRR, relative to the S&P overlaid with the 10-year. And you can see that this is basically the same line. So in addition to tech, equities that are tied to the Infrastructure Investment and Jobs Act and the CHIPS Act, which recently both came out of Congress, they are also dominant leadership. And you can see that here. So their relative performance tends to move in lockstep with rates, as you see here. And industrials have also, importantly, been among the leadership since the start of the 2022 bear market. So when the bear market started back in 2022, you can see that this is when this ETF took on leadership, which coincided with rates going higher. So this is certainly a group that is primed to do well should rates go higher. So industrials are already the number 2 sector. They've been among the leadership for over a year. If you've been following our work, they've been back and forth at the worst case 4. But for the most part, it's been holding in anywhere between 1 and 2. It's currently at 2, recently displaced by tech, but it's already leadership, and I think we can see why we have this significant infrastructure legislature coming out of Congress, and clearly driving the bus here in terms of relative performance, particularly as rates move higher. So another area that we should see leadership should rates move higher, we should see these things lead, are stocks that are primed to do well with rising rates. And typically this ETF is EQRR. These are things like banks and REITs and others that are just have a high correlation with rising rates. And you can see that until the banking crisis, this ETF's relative performance was moving once again in lockstep with rising rates. And of course, during the declining aspect of rates, of course, this ETF was virtually the same exact line. The issue is, of course, since the banking crisis, rates have drifted higher, but the relative performance on this ETF has not. So there's obviously a massive disconnect here. And so the idea being that if we do indeed move higher above 4% on rates, my suspicion is at minimum, that's going to contribute to stability on this ETF, this EQRR, which really is all we need. We don't need it to lead. It would be nice if it did, because that would indicate that it's behaving as it should in a rising rate environment. But what we really need is we just need banks and REITs to stop going down. And I've featured a couple notes recently in the weekly MOTR reports that in our view suggests that banks have stabilized finally, and ultimately for a stable equity environment, that's really all we need. As it stands right now, both financials and REITs remain at the bottom of the heap in terms of performance, so we don't have any exposure here. But it's clearly something that we'll keep an eye on, because if rates do move through 4%, we begin to see the relative performance of this ETF turn higher. This could be a good idea for idea generation ETF as we move forward. We'll keep you posted on that, of course, in the weekly MOTR report. Okay, so just to summarize real quick, leadership remains pro-cyclical and growth-oriented. So stay long there, whether you're long only or long short. This is where the bulk of your long exposure should be. It's technology, industrials, discretionary, materials, and healthcare. And these have been leadership areas of the market for many months now. We've been harping on it in our weekly MOTR reports, in our chart packs that we feature each week. We're trying to focus our subscribers on bases, recent base breakouts, and bases that have yet to break out amongst these 5 leadership sectors. So keep an eye during the week on those weekly MOTR reports for ideas, because it's full of leadership trend stocks that are trending and outperforming. For now, the wall of worry is very large, and the news is potentially likely to get worse as it hits the headlines. But the most important point is that counterintuitively, most of what investors are worried about is actually stock market friendly. We are definitely, of course, mindful of the breadth divergences. There are many ways that this can unfold. Some could be bearish, but our message there is that if it does resolve bearishly, it doesn't necessarily mean that it resolve bearishly now, and it also could resolve bullishly. If this is just the beginning of a new bull market, this is actually the way bull markets begin, where the new leadership takes off and pulls everything else up with it later. So based on what I'm seeing, I'm kind of the mind that's the scenario we'll see unfold, that everything else eventually gets pulled up higher later. But the worst case scenario is that it's a divergence that matters, but it doesn't matter now, and we're on the doorstep of another bubble where everything goes down that's not tied to the bubble, but the bubble is what it is, and that's what you really want to be long. If it is indeed an AI bubble, we suspect that it is very early on, and I just remind you to just do not fear bubbles. If it's indeed what happens, you want to participate. You want to embrace them. And as always, this, it's not like you should start to manage your risk just because it's a bubble. You should always manage your risk. But the point is that the very fact that you do manage your risk is what allows you to participate in bubbles. So keep that in mind if indeed this does start to ramp up. And then lastly, obviously, the trend in rates will be very important to watch. And we don't want to have an opinion. We can have expectations, but we don't want to necessarily have an opinion that we're going to be dogmatic about, because it's really we're not sure how the market is going to interpret changes in the interest rate environment. And so my suspicion is that if rates do move through 4%, we'll see those high growth, expensive stocks start to come under pressure from a relative performance perspective in favor of industrials and other stocks that should do well with a rising rate environment. That would be the expectation. And of course, we have a lot of those in leadership right now. So it would be just a rotation within leadership as opposed to the beginning of a bear market. And that's a key distinction as you process what's happening with rates. Rising rates does not necessarily mean a bear market. It could just drive rotation within leadership. Okay, so that's it for this month. Thank you so much for your time. As always, be sure to keep a lookout on those weekly MOTR reports. Again, we generate lots of ideas in those chart packs for you within the leadership. And if the leadership continues to rotate, of course, our idea generation will rotate with that. If you have any questions, feel free at any time to reach out to either myself or Rick Casella. Our emails are located here. Thanks so much for your time.